5 stocks are getting absolutely flooded with retail money right now as February comes to a close. But here's what nobody's telling you. 3 of these could wreck your portfolio if you buy at the wrong price. 2 of them might actually be sitting at levels that make sense for long-term wealth building. The difference between those outcomes comes down to one thing. Do you know how to separate price from value? Because by the time this video ends, you're going to know exactly which of these 5 stocks deserve your attention and which ones you should avoid like the plague. And I'm not just going to give you names. I'm going to teach you how to think about each one like a real investor. Now, before we dive deep into these 5 names, if you're serious about building wealth in the stock market without gambling or guessing, go ahead and subscribe to Market Edge right now. We focus on teaching you the actual process of investing, how to value companies, how to find your margin of safety, and how to avoid the costly mistakes that wipe out most retail investors. Hit that subscribe button because this channel is built for people who want to win long-term, not just chase headlines. All right, let's get into it. So where is all this retail money actually going? According to recent data from one of the most popular trading platforms in America, 5 companies keep showing up at the very top of the most owned stocks list. And I need to be crystal clear about something right from the start. This is not my personal buy list. This is what the crowd is doing. And the crowd can be right sometimes, but they can also be dangerously wrong. Our job today is to figure out which of these 5 stocks are actually worth owning based on business fundamentals, financial strength, and most importantly, valuation. Because here's a truth that never changes in investing. Popularity fades fast, but valuation always wins in the long run. Let me explain why these 5 names matter and why we need to talk about them. First, these are businesses that millions of Americans recognize instantly. That familiarity creates emotional attachment, and emotional attachment drives buying behavior. People buy what they know, even if they don't fully understand what they're buying. Second, some of these companies genuinely dominate their industries. They have real competitive advantages that are hard to replicate. But third, and this is critical, a few of these stocks are facing serious headwinds right now. Margin pressure, competition, debt loads, slowing growth, things that could make them dangerous at current price levels. So we can't just look at the brand name and assume it's a good investment. We need to dig into the numbers, understand the business model, and figure out what price actually makes sense. That's how you compound wealth over decades instead of losing money chasing what's hot this week. The first stock on this list is a name that's been around for over a century. This is one of the most iconic American companies ever built, a business that literally helped build the backbone of industrial America. I'm talking about trucks, SUVs, vehicles that have been on American roads for generations. And right now, retail investors are piling into this stock for a few specific reasons. First, the share price is low. We're talking around $14. And psychologically, that makes people feel like they're getting a bargain. They can buy hundreds or even thousands of shares without spending a fortune, and that feels good. It feels like ownership. Second, this company pays a dividend. The yield right now is sitting close to 5%, which is attractive if you're looking for passive income. And third, management recently made a strategic shift. They stopped chasing unprofitable electric vehicle sales and refocused on what actually makes money, which is selling traditional vehicles that people want to buy. So on the surface, this looks interesting. The stock I'm talking about is Ford. But here's where we need to pump the brakes and think like investors, not speculators. Ford has some serious structural problems that you can't ignore. The biggest one is debt. Ford is carrying over $200 billion in debt. That is not a small number. And when you compare that to the $12 billion in free cash flow they generated last year, you start to see the challenge. Yes, they're generating cash, but a massive portion of it goes straight to servicing that debt. On top of that, Ford's return on capital is shockingly low. We're talking around 2%. What does that mean in plain English? It means when Ford takes $1 and reinvests it back into the business, they only get about 2 cents of return. Compare that to great tech companies that reinvest capital and get 20, 30, even 50% returns, and you realize Ford operates in a brutal capital-intensive industry where it's hard to create real shareholder value. Now let me give you some context that really drives this home. Back in 1999, Ford generated about $160 billion in revenue. Fast forward to today, and they're doing around $190 billion. That's only 20% revenue growth over 26 years. Even worse, their profit is actually lower today than it was back then. So this is not a compounding machine. This is a mature business in a tough industry trying to stay relevant. Analysts are projecting that earnings per share will grow from about $1.50 this year to close to $3 over the next few years. Revenue is expected to climb modestly. And if Ford can execute on those projections and start managing their balance sheet better, maybe there's some value here. But when I run the numbers and I think about return on capital, debt load, and lack of growth, I just don't see a compelling long-term story. Ford might work for someone who wants dividend income and fully understands the risks, but it's not where I'd personally deploy capital. Now let's shift gears completely and talk about a business that is the total opposite of Ford in almost every measurable way. This is a company that started by selling books online out of a garage and turned into one of the most powerful commercial engines on the planet. If you've bought anything online in the last month, there's a very high chance this company was involved. And retail investors love this stock because it feels familiar, it feels essential, and it feels like it has room to grow. But here's the twist. This stock hasn't kept pace with some of the other big tech names recently, which makes a lot of people think it's a laggard with serious catch-up potential. The company I'm talking about is Amazon. Let me break down what Amazon really is today, because most people only see the surface. Yes, they run the largest e-commerce platform in the world. You order something, it shows up at your door in 2 days or less. That's the part everyone knows. But that's not even the most profitable piece of the business anymore. Amazon Web Services, which most people call AWS, is a cloud computing division that literally powers a massive chunk of the internet. This is where companies store their data, run their applications, build artificial intelligence systems. AWS is incredibly profitable, and it's growing at double-digit rates. On top of that, Amazon is in logistics, advertising, streaming video. They broadcast NFL games. They're everywhere. This is a company operating in multiple high-growth industries simultaneously, and they have the infrastructure and scale to dominate in all of them. Now here's the challenge with Amazon. The market cap is sitting around $2.6 trillion. That's enormous. And when you look at the enterprise value, it's only slightly higher, which tells you their debt load is manageable. In fact, Amazon has roughly the same amount of debt as Ford, but look at the difference in output. Amazon generates $700 billion in revenue compared to Ford's $190. They generate $76 billion in profit compared to Ford's $4 billion. Their gross margin is around 50%. Their net margin is over 10%. Those numbers scream efficiency, pricing power, and competitive dominance. But here's the catch that trips people up. Amazon's free cash flow has been declining recently. And when people see that, they panic. They think the business is broken. But if you actually understand what's happening, you realize this is a temporary situation driven by aggressive reinvestment. Every time Amazon builds a new fulfillment center, every time they invest billions into AWS infrastructure to support AI growth, that spending eats into free cash flow in the short term. But those investments set up massive future cash generation. So yes, on paper, the free cash flow multiples look high right now. But this isn't a struggling business. This is a dominant business reinvesting for the next decade of growth. Analysts expect earnings per share to grow from around $8 this year to $14 in 3 years. That's substantial growth. Revenue is projected to grow 10 to 12% annually, which is remarkable for a company this large. If those projections play out, and I think they will, Amazon could be a serious long-term compounder. The question is always price. Right now, the stock is hovering around $200. Is that cheap? Not really. Is it expensive? Depends on your time horizon and what you believe about the future of cloud computing and e-commerce. For me personally, Amazon is a company I want to own, but only at the right price. I'd be looking at levels closer to 180 or even lower before I start building a serious position. And that's the key lesson here that I want you to really absorb. A great company is not always a great investment. If you overpay, even for the best business in the world, your returns will suffer. Price matters, valuation matters, patience matters. All right, if this is making sense to you and you're getting value from this breakdown, do me a favor. Drop a comment below and let me know which of these 5 stocks you're most interested in, or if you own any of them already. And if you think this kind of analysis could help someone else make smarter decisions with their money, share this video. That's how we grow Market Edge and keep delivering content that actually teaches instead of just hypes. Now let's talk about stock number 3, and this is a name that genuinely needs no introduction. We're talking about a company that didn't just create products, they created an entire ecosystem that billions of people around the world depend on every single day. This is a business that turned the smartphone into something people literally cannot imagine living without. Before I tell you the name, think about this. Almost 2 billion people use products from this company daily. The hardware, the software, the services, everything works together seamlessly. And the brand loyalty is unlike anything else in business. People line up for days when they release a new product. They pay premium prices without hesitation. And once you're in the ecosystem, you rarely leave. The company I'm describing is Apple. So why are retail investors flooding into Apple right now? A few key reasons. First, it feels safe. It feels stable. Unlike some of the other tech giants that are spending tens of billions on speculative artificial intelligence projects with uncertain returns, Apple has been more disciplined with capital. They're not betting the farm on risky moonshots. They're sticking to what they do best, which is building premium hardware and steadily growing a high-margin services business. That services division, by the way, is absolutely massive. We're talking about the App Store, Apple Music, Apple TV+, iCloud storage, all these subscription-based revenue streams that generate recurring cash flow month after month. And the margins on services are significantly higher than hardware margins. Second, Apple returns cash to shareholders consistently and aggressively. They buy back billions of dollars worth of stock every single quarter. They pay a dividend that grows over time. For investors who want reliability and tangible cash returns, Apple checks a lot of boxes. And third, the balance sheet is fortress-level strong. Apple has about half the debt that Ford carries, but generates 30 times the profit. Their return on capital is hovering around 60%, which is world-class. When Apple reinvests $1 back into research and development or new product lines, they get incredible returns on that capital. This is what great businesses look like on paper. But, and this is a big but, quality always comes at a price. Apple is trading at a market cap approaching $4 trillion. The stock is sitting around $230 per share. And when you start running valuation models, you realize that you're paying a significant premium for this business. The question every investor has to answer is that premium justified? Analysts are projecting earnings growth in the range of 10 to 20% annually over the next several years. If Apple can continue growing their services revenue, if they can keep buying back shares when prices are reasonable, and if they can maintain their brand dominance and customer loyalty, then maybe this valuation is fair. Maybe it's even cheap relative to what the business will look like in 10 years. But here's my personal take, and this is important. Even the best businesses in the world can be terrible investments if you overpay. Warren Buffett, one of the greatest investors who ever lived, has been selling Apple shares recently. Does that mean Apple is a bad company? Absolutely not. Does it mean the stock might be priced for absolute perfection with no room for disappointment? Possibly. For me, I would want to see Apple closer to 180 or 190 per share before I'd start building a meaningful position. That gives me a margin of safety. That gives me room for the unexpected without taking a massive loss. And that's how you protect capital while still positioning for upside. Now I know what some of you are thinking. We've covered 3 stocks so far: Ford, Amazon, and Apple. But there are 2 more names on this list that retail investors are absolutely obsessed with. One is the company that's literally powering the entire artificial intelligence revolution. The other is the most talked about electric vehicle maker in the United States, led by one of the most polarizing figures in business. Both of these stocks come with massive opportunity and massive risk, depending on how you look at them. Let's talk about the AI giant first. This company went from being a niche player making graphics cards for video gamers to becoming the absolute backbone of the artificial intelligence industry in just a few short years. Every major technology company building AI right now depends on this company's hardware. Microsoft needs them, Google needs them, Amazon needs them, Meta needs them, Tesla needs them. If you're building large language models, if you're training neural networks, if you're running data centers for machine learning, you need chips from this company. The stock I'm talking about is Nvidia. Nvidia's rise has been nothing short of extraordinary. The stock has gone parabolic over the last 2 years as AI hype reached fever pitch. And to be fair, it's not just hype. The demand for their GPUs is real. The revenue growth is real. The profit margins are real. But here's the reality that makes Nvidia tricky to evaluate. The stock is priced for continued hypergrowth. It's priced for a future where AI spending accelerates indefinitely. If that future plays out, if companies keep pouring hundreds of billions into AI infrastructure, if Nvidia maintains its competitive moat, then the current valuation could make sense. But if AI spending slows down, if competition increases from companies like AMD, or if the big tech giants start designing their own custom chips to reduce dependency on Nvidia, then this stock could face serious headwinds. This is a situation where you have to be very honest with yourself about what you're betting on. Buying Nvidia today is not just buying a semiconductor company. You're making a bet on a very specific vision of the future. You're betting that AI will continue to transform every industry. You're betting that Nvidia will maintain dominance. You're betting that margins stay high. That's a lot of things that need to go right. I'm not saying don't own Nvidia. I'm saying understand the risk-reward profile and make sure it fits your strategy and risk tolerance. If you're a long-term investor who believes in the AI thesis and you're willing to ride out volatility, Nvidia could work. But if you're chasing momentum without understanding the business, you could get hurt badly. And finally, let's talk about the 5th and most controversial stock on this list. This is a company that has one of the most passionate fan bases and one of the most vocal groups of critics at the same time. It's the most popular electric vehicle brand in the United States, led by Elon Musk, one of the most influential and unpredictable entrepreneurs alive. The company is Tesla, and Tesla divides people like almost no other stock in the market. Some investors think Elon Musk is a visionary who's going to revolutionize transportation, energy, and robotics. Other investors think Tesla is wildly overvalued and riding on hype more than fundamentals. So what's the truth? Let's look at the facts. Tesla makes electric vehicles. They're the most recognized EV brand in America. But recently, they got surpassed in global sales by a Chinese company called BYD. On top of that, Tesla's revenue growth has slowed significantly compared to a few years ago. They're facing more competition from traditional automakers who are finally getting serious about EVs. They're dealing with margin pressure because they've had to cut prices to maintain market share. And there's real uncertainty about future demand, especially as the EV market matures and growth rates normalize. But here's what makes Tesla interesting and why people still buy the stock. Elon Musk doesn't position Tesla as just a car company. He talks about full self-driving technology. He talks about robotaxis. He talks about energy storage and solar. He talks about humanoid robots. If even one of those big bets pays off in a meaningful way, Tesla could be worth multiples of its current valuation. But if none of them materialize, or if they take much longer than expected, then you're overpaying for a car company with decelerating growth. That's the gamble with Tesla. It's not a traditional investment. It's a high-risk, high-reward speculation on Elon Musk's ability to execute on multiple moonshots simultaneously. So let me pull all of this together for you. We've walked through 5 stocks: Ford, Amazon, Apple, Nvidia, and Tesla. Each one has a completely different story. Each one has different risks, different opportunities, and different valuation challenges. But here's the single most important lesson I want you to take away from this entire video. Popularity does not equal value. Just because millions of people are buying a stock does not mean you should. Your job as an investor is to understand the business you're buying, know what it's actually worth based on cash flow and growth prospects, and only commit capital when the price gives you a real margin of safety. Don't chase stocks because they're going up. Don't buy just because everyone else is buying. Don't fall in love with brands and ignore the numbers. Invest with discipline, invest with patience, invest with a process. That's how you build long-term wealth in the stock market. If you want to learn more about how to think like this, how to analyze businesses, how to value stocks properly, check out the other videos here on Market Edge. We're building a library of content designed to help you become a better, smarter, more confident investor. And just as a reminder, nothing in this video is financial advice. I'm not a licensed financial advisor. This is purely for educational purposes. Always do your own research, understand your own risk tolerance, and make decisions that are right for your personal situation. Thanks for watching Market Edge. I'll see you in the next one.